There's a lot of noise when it comes to money and investing, stock tips, headlines, opinions. But the reality is, most wealth isn't built on noise. It's built on structure, discipline, and time. This podcast is about editing out that noise and focusing on what actually builds wealth. I'm Denise El Chaar, and this is the Private Wealth Edit. I spent my career managing money and investments for institutions and high net worth families. And over time, one thing's become very clear to me. The way sophisticated investors think about money is very different from what most people are taught, or not taught, but do. This podcast is about closing that gap. Each episode, I'll focus on what actually matters, cutting through complexity to bring clarity to how wealth is built. I'm here to give you an institutional edge, one private conversation at a time. Before we begin, a quick note. This podcast is for informational purposes only and does not constitute investment advice. All investing involves risks, and you should consult your own advisor before making any financial decisions. In the last episode, we talked about one of the most common misconceptions in investing, and that is most people focus on transactional, the stock picking. I reframed that, moving away from stock picking and towards something far more important, and that's structure. Because real investing isn't about chasing ideas or a stock. It's about building a system, one grounded in asset allocation, risk, and time horizon. Most people think investing is about picking the right stock, what to buy, what to sell, what's going up, what's the new thing. But that's not investing. I'd say that's actually guessing or even gambling. Real investing is not as about individual decisions. It's about building a system. A structure that connects your goals, your risks, and your time horizon in a portfolio that can actually grow and withstand change and volatility. Today, we're going to build on that idea, and we're going to look at how portfolios are actually constructed at a high level. Because when you understand how sophisticated investors approach this, it really changes how you think about your wealth and your own investments. So today we're going to talk about asset allocation, which is the secret sauce to investing and the building blocks underneath it. When wealthy families and institutions that advise them build portfolios, they don't start with a stock trade. They don't begin with what should we buy or what fund is performing best. They start with asset allocation because allocation is what ultimately drives outcome over time. And that's a really important distinction because asset allocation is the secret sauce in investing. It's what all the professionals know about in investing, but most people don't. And it's the topic of today's episode. Products change, markets change, managers change. But the structure of a portfolio and how you distribute capital across it tends to be the most stable and the most influential decision. It's the one thing most people are not talking about that is the most important thing. It defines how a portfolio behaves, how it responds to volatility, and how it compounds over time. So, wealthy families and sophisticated institutions, when they build a portfolio, they start here. They're not asking what stock is the most exciting or what manager has performed best. They're asking about how much equities should they have, how many bonds should they have, what should their allocation be to alternatives. And that distinction matters. So at the high level, most portfolios are built around a few categories of investments. The first, the most talked about, the sexiest one are public equities or stocks. The next is fixed income or bonds. And the third, increasingly, are alternative investments. And each of these play a different role. Equities are typically the primary driver of long-term growth. Fixed income tends to provide stability, income, and diversification, particularly in periods of uncertainty. They tend to go up when equities go down, providing an offset of sorts or a buffer. And then there are alternatives, which is a lot of other stuff, things that might not fit into those other two categories. It's private equity, it's private credit, it's real estate, it's Bitcoin, it's gold. And these all often provide enhanced returns and a different source of risk. We consider those assets as non-correlated assets in that they don't move in the same direction necessarily as equities or fixed income. But do you see what we're doing here? We're starting to see the building blocks of the system. We're starting to build the system. And what matters is not just owning these categories, but understanding why they're there and what role they serve. how they interact, and how they behave under different conditions. Let's go a little bit deeper into equities, stocks. So, at a high level, equities represent ownership in companies. And over long periods of time, they've historically been one of the primary drivers of portfolio growth. But that growth comes with variability. Equities tend to be more volatile, more sensitive to economic conditions, and more reactive to market sentiment, which means their value can fluctuate significantly in the short term. So within a portfolio, equities are typically positioned as the growth engine, the part of the portfolio designed to increase value over time. The second big bucket, as we mentioned, was fixed income, or bonds. At a basic level, bonds represent lending. You're lending money to a company or an entity in exchange for income and the return of your principal at the end or over time. The biggest fundamental difference between equity and fixed income is this. When the shit hits the fan, bonds are higher in the capital structure and will be repaid first. So, for high quality bonds, you can have a great degree of confidence that you'll be repaid your principal and interest. There's an end date on with a bond. That's the date, what we call the maturity date, where you're going to get your principal back. With stocks, you have to sell them in order to get your original investment back. And as we talked about, stocks fluctuate over time. So there is a possibility that when you need that principal back, the stock is lower than when you bought it. But that's the risk and return. There are episodes, and we call these bear markets, where stock prices actually fall, and you might not be able to get your original investment back when you need it. So, compared to equities, fixed income has historically offered lower returns, but much, much greater stability. It tends to behave differently in periods of market stress. As we talked about, it moves in opposition to equities and can provide a level of predictability that balances a portfolio. But it's important to understand, too, our bonds are not risk-free. They are sensitive to interest rates and credit quality and the broader economic conditions. So its role is not to eliminate risk, but to provide structure, income, and diversification alongside equities. The last bucket I want to talk about today are what we call alternatives. And this includes a wide range of investment opportunities: private equity, private credit, real estate, Bitcoin, gold, and other strategies that don't neatly fit into really public markets. Alternatives are often used to enhance returns, diversify sources of risk, or access opportunities that aren't necessarily available in the public markets. But they also come with different characteristics. They are often less liquid, and this is the biggest, most important thing to remember. You can't just go and necessarily sell an alternative investment as quickly as you could a bond or a stock. They do not have the same liquidity as public markets, and you should consider it as an illiquid part of your portfolio, meaning it could take you a while to get your money back. So let me put that in perspective for you. Some private credit funds, the majority, will limit returns of 5% a quarter. So that means it could take you up to 5 years to get your original money back. Now, in theory, you get paid for that illiquidity. They're useful when used thoughtfully and can add another dimension to your portfolio. Individually, each of these assets has its own characteristics, but the real value comes from when you understand how they all work together. Equities drive growth, fixed income provides stability, and alternatives offer additional diversification. And that brings us back to our old friend, asset allocation. And these are the building blocks underpinning that. So if there's one thing I want you to take away from the episode, it's this. Investments don't exist in isolation. They play roles. And when those roles are clearly defined, portfolio construction becomes less complex. It becomes more about clarity than complexity. So in the next episode, we're going to talk about my favorite topic, and that is time. Time, it heals all wounds, and it really brings the magic to investing. The last part of the episode today, I want to talk about the edit and what's actually happening in markets and what does it mean for you. So right now, markets are reacting to one continued theme, and that's oil. With the escalating conflict in the Middle East, or I should say the never-ending conflict in the Middle East, oil prices have spiked. And this is dragging on and doesn't look like we're going to have a quick resolution. And even if there are a resolution today, there's been infrastructure damage to the oil production facilities in the Middle East, and we could see higher oil prices for a while. There are huge tectonic shifts happening in the oil sector right now, and the impacts will be felt for some time. So naturally, everyone's asking the same question. Are we heading back to the 1970s and the oil crisis of the 1970s? Do you remember the 1970s? Maybe some of you weren't even alive in the 70s, or maybe you're too young to remember. And I'm not going to tell you which category I fall into, but let's talk about what happened in the 70s. There were two significant oil shocks. There was one following the Yom Kippur War in 1973, and then one following the Iranian Revolution in 1979, all in the Middle East. Here we are all over again. History is rhyming. In both cases, oil spiked and was in very short supply, causing great economic damage and hardship. In the United States, even, we actually had gas rationing in the United States. And it's crazy to think about today, but in gas stations across the country, they ran dry. They put up red flags on the pumps showing you that the pumps were empty, and drivers would sit in lines waiting for pumps that actually did still have gas. That's actually happening right now in parts of Asia because they rely mostly on oil that comes through the Strait of Hormuz. Something like 80% of the oil going through the Strait of Hormuz is used by Asia. This disruption has rippled through every corner of the economy in the 70s. Transportation costs soared, electricity bills climbed, and businesses passed those higher costs straight on to you and me, the consumer. So, back to the original question, are we going back to the 70s? Are we going to see shortages and high costs? So, I think the short answer is no, but it's not nothing. Let me explain that. Back in the 70s, oil shocks were really devastating. Prices quadrupled, inflation surged into the teens, and unemployment spiked. It triggered a full-blown stagflation environment that took over a decade and very high interest rates to fix. But today looks very, very different. The first and the most important thing is the global economy is far less dependent on oil. We've changed the way we do business, so to speak. We use energy way more efficiently, and the structure of our growth has really shifted. Second, and this is really critical, the U.S. is now effectively a net exporter of petroleum. So higher oil prices don't just hurt, they also benefit a huge part of the economy. And then third, central banks are no longer guessing. They are laser focused on inflation, and they will act quickly to contain it. So, what does that mean for markets? Well, here's the reality. Higher oil prices act like a tax on consumers and businesses. Gas prices rise, margins get squeezed, and growth slows on the edges. But this is not a systemic collapse scenario, at least not yet. In fact, if you look at history, markets tend to behave in a very consistent way during geopolitical shocks. They sell off very quickly on the uncertainty, and then they recover once the situation stabilizes. And that's a key insight. Markets don't price fear forever, they price outcomes. In a short disruption, you get volatility and maybe a temporary sell-off. In a prolonged shock, there are some where you're starting to see economic damage. You can see markets react much more intensely. But for long-term investors, the playbook is actually really simple. Stay invested, stay diversified, and stay disciplined. And this is the big, big point because historically, markets recover and often faster than expected. So let me just say that again. Stay invested, stay diversified, and stay disciplined. If you enjoyed this topic and you'd like to go a little bit deeper, please look at the website. And I have a blog posting on this called Not Your Parents' Energy Crisis. And of course, if you have any questions you like or topics you'd like me to address, please email me. Thank you for listening today. If you found this useful, follow the show or share it with someone who you think might find it interesting. Send it to your kids. If you have any questions that you'd like to ask or topics you'd like me to cover, please email me at privatewealthedit@gmail.com. And remember, I'm here to give you an institutional edge, one private conversation at a time.